America is a ticking time bomb, but the fuse isn't always visible. Right now, tensions with Iran are escalating, and the financial tremors could soon rock your world. Forget geopolitics for a moment. This isn't about distant battlefields. It's about your bank account, your mortgage, your ability to afford rent. Imagine gas prices soaring by 200% or inflation hitting double digits, turning your $100 into just $80. Experts estimate a major conflict could slash household wealth by an average of $15,000 within a year. This isn't just about an economic downer. We're talking about a very real risk of a nationwide homeless crisis. We'll expose how a war thousands of miles away could literally put your financial future on the street. Don't look away. Your wallet is on the line. The oil shock. How your commute gets crushed. Let's start with the most immediate and glaring impact. Oil. The global economy runs on oil, and a significant portion of that oil, roughly 20% of the world's total supply, passes through a narrow waterway called the Strait of Hormuz. Iran borders this strait. If tensions escalate into open conflict, Iran has repeatedly threatened to close this vital choke point. Consider what happened during the 1973 oil crisis. An oil embargo by Arab states caused crude prices to quadruple, leading to widespread rationing and economic disruption in the U.S. Or during the Iran-Iraq War in the 1980s, when attacks on tankers significantly disrupted oil flows. Today, the world consumes approximately 100 million barrels of oil per day. A major disruption in the Strait of Hormuz could realistically remove 15 to 20 million barrels per day from the global supply. Such a shock would be unprecedented in modern history. Even a perceived threat could cause oil prices to skyrocket. Imagine Brent crude, which has historically traded around $70 to $80 a barrel, suddenly leaping to $150 or even $200 a barrel. What does that mean for you? Well, the price of gasoline at the pump is directly tied to crude oil. For every $10 increase in the price of a barrel of oil, you could see roughly a 25 cents to 30 cents increase per gallon at your local gas station. If oil hits $150 a barrel, your average gas price, let's say it's currently $3.50, could easily hit $5 or more. This isn't just an inconvenience. It's a significant chunk out of your weekly budget. And it doesn't stop there. Higher fuel costs translate to higher shipping costs for everything, from the food in your grocery store to the electronics you order online. These increased costs are then passed directly onto you, the consumer. The inflation monster, your dollar's shrinking power. The ripple effect from an oil shock extends far beyond a gas pump. It triggers what economists refer to as cost-push inflation. When energy, a fundamental input for nearly every product and service, becomes more expensive, businesses face higher operational costs. For instance, the average cost of transporting a 40-foot shipping container from Asia to the U.S. East Coast can range from $4,000 to $8,000. A war-induced oil shock could easily add 20 to 30% or more to these figures due to fuel surcharges and increased insurance. These costs are then passed on. The price of bread, manufactured goods, even your monthly utility bill, all would see significant increases. Consider the U.S. Consumer Price Index, or CPI, which measures inflation. While the Federal Reserve aims for a 2% annual inflation rate, a major economic shock could push that number into 5%, 8%, or even double-digit range, mirroring periods like the late 1970s. When inflation spirals, the purchasing power of your dollar diminishes rapidly. What $100 bought you last year might only buy you $90 worth of goods next year. How would central banks, like the Federal Reserve, respond? Typically, by raising interest rates to curb inflation. If the Fed were forced to hike rates significantly, say from a current range of 5.25% to 5.50% to 7% or 8%, this would dramatically impact borrowing costs. Your mortgage interest rates, currently perhaps around 7% for a 30-year fixed loan, could jump to 9% or 10%. Car loans, credit card interest rates, all will become more expensive, making it harder for everyday Americans to afford big purchases or manage existing debt. In the most severe scenario, we could face stagflation, a toxic combination of high inflation and stagnant economic growth, a phenomenon the U.S. last truly experienced in the 1970s. Market meltdown. What happens to your investments? Now, let's talk about your investments. Your 401k, your Roth IRA, your brokerage account. These are all vulnerable to geopolitical tremors. Global financial markets detest uncertainty, and a war in the Middle East, especially one involving a major oil producer like Iran, would unleash a torrent of it. In times of extreme crisis, investors typically flee risk assets like stocks and pour money into safe haven assets such as gold, the US dollar, and US Treasury bonds. Consider historical market reactions. During the 1990 to 91 Gulf War, the S&P 500 initially dropped by roughly 17% in the months leading up to conflict, though it recovered quickly once the war's outcome became clear. A prolonged, unpredictable conflict with Iran, however, could see deeper and more sustained declines. Analysts often model potential market drawdowns based on different scenarios. Some estimates suggest a major escalation could lead to a 20 to 35% correction in major equity indices. If your retirement portfolio is heavily weighted in stocks, a significant portion of your hard-earned savings could evaporate in a relatively short period. Which sectors would be hit hardest? Airlines and the broader travel industry would suffer immensely from higher fuel costs and reduced consumer travel. Discretionary spending on things like restaurants, entertainment, and luxury goods would plummet as consumers tighten their belts. Conversely, some sectors might see a temporary boost. Defense contractors, for instance, often see increased orders and stock price surges during conflicts. But for the average investor, diversification, while always important, might only partially cushion the blow of a systemic market shock. Protecting your investments during such an event requires foresight, not just luck. Supply chain chaos, empty shelves and delayed deliveries. Beyond oil and direct investment impacts, a conflict with Iran would throw a wrench into finely tuned gears of global supply chains. The vast majority of the world's goods travel by sea. The Strait of Hormuz is not just for oil tankers. It's a critical gateway for container ships carrying everything from electronics components and clothing to pharmaceuticals and automotive parts. If this vital shipping lane becomes a war zone, shipping companies will face monumental challenges. Insurance premiums for vessels transiting the region could skyrocket, making routes prohibitively expensive. Many companies would choose to reroute their ships, adding weeks, even months, to transit times. For instance, bypassing the Suez Canal and sailing around the Cape of Good Hope adds an average of 10 to 14 days to a journey from Asia to Europe or the U.S. East Coast, significantly increasing fuel consumption and operational costs. Even without direct attacks, the threat of conflict can lead to port congestion, customs delays, and a general slowdown of goods movement. The just-in-time inventory systems many businesses rely on would collapse, leading to widespread shortages. Imagine delays for critical medical supplies, or a lack of components that halts production at U.S. factories. During the early days of the COVID-19 pandemic, we saw what even localized supply chain disruptions could do. Empty shelves for toilet paper, hand sanitizer, and even basic foodstuffs. A major war in a critical shipping region would amplify those issues exponentially. The cost of a 40-foot container from Shanghai to Los Angeles, which surged over $20,000 during the pandemic supply chain crisis, could easily reach similar or even higher levels, pushing up the price of nearly every imported good. Beyond the headlines, hidden costs and long-term scars. The economic fallout of an Iran conflict extends far beyond the immediate shocks. There are the hidden costs, the long-term scars on the American economy and psyche. First, consider military spending. Wars are incredibly expensive. The Iraq War, for example, is estimated to have cost the U.S. upwards of $2 trillion, and some estimates project its total long-term cost, including veteran care, to exceed $6 trillion. A conflict with Iran, given its significant military capabilities and potential for protracted engagement, could easily rack up costs in the hundreds of billions, if not trillions of dollars. This increased military spending would inevitably lead to a ballooning national debt. The current U.S. national debt already stands at over $34 trillion. Adding trillions more to that burden would increase interest payments on the debt, diverting more and more of the national budget away from crucial domestic programs like infrastructure, education, and healthcare. This is money that could be invested in improving American lives, instead spent on conflict. Furthermore, a protracted conflict would destabilize an already delicate global economic order. Investor confidence would plummet globally, reducing foreign direct investment in the U.S. and impacting international trade agreements. We could see a significant downturn in global growth, impacting demand for American exports and potentially leading to a worldwide recession. The long-term geopolitical instability could also lead to persistent higher energy prices, even after active hostilities cease, as regions remain tense and supply security becomes a permanent concern. The true cost of war isn't just measured in dollars spent, but in missed opportunities for growth, innovation, and prosperity. Preparing for impact, protecting your wallet. So, faced with such a daunting prospect, what can you, the individual, do to protect your wallet? While no one can predict the future with certainty, preparing for economic uncertainty is always prudent. Firstly, build or bolster your emergency fund. Aim for at least 3 to 6 months' worth of living expenses in a readily accessible savings account. This provides a crucial buffer against unexpected job loss, rising costs, or market downturns. Secondly, review your investment portfolio. While I can't offer financial advice, generally, consider if your investments are diversified across different asset classes and geographies. Evaluate your risk tolerance in light of potential volatility. If you're nearing retirement, you might consider adjusting your allocation to be more conservative. Thirdly, focus on reducing high-interest debt, especially credit card debt. In an environment of rising interest rates, carrying significant revolving debt becomes exponentially more expensive. The average U.S. household with credit card debt carried over $7,000 in Q4 2023, with average interest rates exceeding 20%. Reducing this burden will free up significant cash flow. Finally, stay informed. Understand the broader geopolitical landscape and how it might impact economic trends. Don't fall prey to sensationalism, but arm yourself with knowledge. Recognize that economic interconnectedness means that events far away can have a very real impact on your daily life. The potential for an Iran war is America's ticking time bomb, and its fuse is intricately linked to your financial well-being. Understanding these connections is the first step towards navigating the storm and ensuring that your wallet and your future are as protected as they can be. The unseen threat. Why Iran matters to you. You might think that tensions in the Middle East, particularly with a nation like Iran, are distant concerns confined to the evening news. But what if I told you that potential conflict thousands of miles away could directly impact your bank account, send gas prices spiraling, and shrink the purchasing power of every dollar you earn? It sounds alarmist, perhaps, but the economic threads that connect the United States to this volatile region are more numerous and fragile than you might imagine. For decades, the relationship between the U.S. and Iran has been a complex dance of diplomacy, sanctions, and proxy conflicts. From the 1979 Iranian Revolution to the more recent nuclear deal negotiations and their subsequent unraveling, the hostility has ebbed and flowed, but a fundamental tension has always remained. And right now, that tension feels particularly acute. Do you know how a war thousands of miles away could drain your bank account or send gas prices through the roof? The answer lies in understanding the critical economic arteries that run through this region and how easily they can be severed.